Okay, so under environment for financial management, we look at the decisions that a finance manager is going to be taking to see the prospect of the business. And we said that one of those decisions is financing decision. And we have all agreed that financing decision has to do with the finance manager deciding on the means that they will be using to finance the investments that they want to undertake. Where are we going to get money to be able to carry out the investment that we want to carry out? And we say that the finance manager can decide to use either short-term or long-term means to finance the operations. We are not going to be focusing on the short term because the short term, it will take a short period for you to settle them. So we'll be talking about the long term, which is going to be about the equity, debt, and other stuff. Okay. If these people are going to be giving you money, okay, as an entity, if you are going to be taking money from people, the people are not going to be giving the money to you for free. Okay, they are going to be expecting something on the money that they are giving to you. So if the owners are bringing money, they are not bringing the money for free because anything can happen and their money will go like that. So you need to be able to give them something so that the time that their money or the time that the company will not be able to operate again, they will be able to recover their money that they are investing in the form of something. Or they could have used that money in a different way to make profit. But since they are not putting the money into that particular thing, you have to reward them for sacrificing the money uh, for your usage or whatever. Okay. The same way, if banks are giving you loan, they are going to be giving you the loan not for free. They are going to be expecting something on the money because that money could have been used by the bank to do something else. Okay. So the bank would have used that particular thing to do something else, but they are giving it to you. So they will not give this thing to you for free. So what you are going to be paying for using someone's money, that's we are calling the cost of capital. So if you come to equity now, if you come to equity or ordinary shares, if an entity issue ordinary shares, the individuals who are going to purchase these shares are going to be receiving dividends. So in this case, the dividend is the cost of capital. This is the cost that you are incurring for using the equity share. So the cost of capital for dividend is now what? For equity shares is the dividend. So the cost of equity is the dividend because if you issue equity shares, you are going to be paying dividend to the people. Okay. But if you issue debentures, or bonds, you are going to be paying interest. So the cost of issuing debentures or the cost of venture is going to be the interest that you pay. If you issue preference shares, you are going to be paying dividends. So if you issue preference shares, you are going to be paying dividends. So the dividend is going to be the cost of the preference shares. We are not interested in the amount that you are paying. Okay, we want to know what percentage are you paying as that amount. That is what we are coming to determine. So if you are paying a dividend of 10 cedis, the question is what percentage of whatever you are paying is the 10 cedis. So we are interested in the percentage. So we are going to be looking for the rates that represent the amount that you are paying. So if you are taking a loan from a bank loan, you are going to be paying interest. So all these are what we are calling the cost of capital. But sometimes before you can have access to these items, you are going to be incurring a cost. So if you want to issue equity shares, you might be incurring issuing shares, or you might be incurring issuing costs. Okay, if you want to issue equity shares, you might be incurring issuing costs. If you want to obtain loan, you might be paying processing fee. All those costs that you incur to raise and use funds, we call it the cost of capital. So the issuing cost is going to be part of the cost of capital. the dividend that you are going to be paying or the interest that you're paying for using that particular money or using someone's money is going to be the cost of capital. Okay, but how do we determine this cost of capital? We are going to be looking at that one by one. All things being equal, we might be doing only equity for today. Then Thursday, now we do debt. Then in the afternoon, we do weighted average cost of capital and those stuff. So we are going to be looking at them one by one. The cost of capital, we look at the entity using only equity. One entity raising funds and they are raising the funds through equity. What it means that they are issuing only ordinary shares. So we are going to be finding the cost of equity alone. Then we also assume that one entity is raising funds only through debt, issue of debt. Then we find cost of debt. Then we also assume that one entity is using the combination of the two. The entity is using a portion of debt, a portion of equity. Then we now find what is the one cost of the capital. Because if you are using debt and equity, they are coming at different interest rates. But at the end of the day, what is the total interest that you are paying, or what is the total return that you are paying, and what percentage represent the total return? So you'll be looking at weighted average cost of capital. So you'll be looking at cost of equity, assuming an entity is issuing shares only through equity. Okay. Then we come here. Then we come to cost of debt, assuming the entity is issuing the shares through only debt. So the debt over here, we are going to be limiting it to debentures and bonds. Then we also look at the entity can also issue shares through only preference shares. So we'll be looking at cost of preference shares. Okay, preference shares, although it's treated as debt, the debt itself, the interest on it is deductible, but preference shares dividend on it is not tax deductible. We look at why we mean by the one thing is tax deductible and one that one is not tax deductible. Okay, then we come to weighted average cost of capital, which we call the WACC. So this is what we are going to be doing. Very simple situations today. Weighted average cost of capital. Weighted average cost of capital. So if we have some time, I will tell you how to calculate weighted marginal cost of capital. Okay. So these are what we are going to be looking at. Okay. Whatever return that you are going to be paying on an investment for somebody is going to be determined by the risks being faced by that particular person. So if you are bringing money to me now, whatever return that I will pay depends on the risks that you are going to be facing by investing in me, or the risks associated with operating, or the risks associated with my operations, or the risks associated with investing, the risks associated with investing in my securities. So if you come here, if I'm having a lot of debt already, if you are coming to invest in me, it means that I'm likely to be out of business. So the money that you are going to be charging me, or the return that you are going to be expecting on your investment is going to be higher. But if I'm a company that I don't have any liquidity issue, I don't have any problems, I'm not owing people that much, I have a lot of cash to operate. If you bring money to me, the investment that you are going to be bringing, or the investment that I'm going to be paying you, to also depend on whatever you are going to be facing. So whatever return that we are going to be determining is going to be based on the risks that the investor is fixing, or the risks that a company is fixing. And that particular risk can be what we call the business risks, the operational risks, what we have done the last time. So we have the business risks, the operational risks, and the financial risks. So we look at all those for the last time, and the financial risks. So whatever return that will be paid to you is going to be depending on the risks being faced by the entity, or whatever risks that you are going to be exposed to. So the higher the risks, the higher the return. The lower the risk, the lower the return. So if you come to most of the time, if you come to securities, especially maybe the public securities, government securities, sometimes you see that the interest rate is lower because you have been exposed to a lower risk. What it means is that whatever happens, you'll be able to get your money back. So sometimes we say the government securities are risk-free because you cannot lose your principal. Okay, whatever happens, you are not going to be losing your principal. You get your money back. Whatever happens, you get your money back. So you see, government securities are risk-free or something. But that is not an issue. Let's look at this particular one. We have done time value of money. So we are going to be applying the time value of money to determine the cost of equity. Okay. But let's move on. I'm saying that the cost of capital is the return that the cost of capital over here, from all the explanation that I've given, the cost of capital is the return that people are expecting on the money that they are giving to you. So if I'm giving you a certain amount of money to use, what I'm expecting you to pay to me every year or every day based on the money that I've given to you is the cost of capital. That is the cost of using that money. But the cost of capital is the rate of return that the providers of capital are expecting on their investment. And this cost of capital can be the cost of raising the money. Okay, the cost of raising. So the cost of raising the funds. What is the cost of raising the funds? If you go to a bank, you are going to be paying processing fee before they will give you a loan. If you want to issue shares, you are going to be incurring issuing costs before you get a capital. So if not for the issuing of the equity, you will not incur that issuing cost. So the issuing cost and then the processing fee are all going to be part of the cost of raising the funds, and the return that you are going to be the cost of using. Let me just say the cost of using the fund. That is going to be the return. Cost of using the funds that you have raised. Okay. The funds raised. So the cost of using the funds raised is the return that you are going to be paying on the money for the people. So it's going to be any cost that you incur as a result of raising the fund. The interest that you are paying is going to be part of it. The issuing cost is going to be part of it. But let's come here and deal with cost of equity alone. So we will be on cost of equity. So we have two ways of determining cost of equity. We'll be looking at that one by one. So we have what we call using dividend, because a dividend is the what? Is the return. So we have a dividend valuation model. Okay. Dividend valuation model. The dividend valuation model is based on dividend payments, which we might not be taking into consideration the risks being exposed to by the entity, or the risks being exposed to by the securities of the entity. So under this one, we are going to be using constant dividends. Constant dividend. That we are going to be saying that dividend is going to be 10 cedi every year. Okay. Then we come here, we come to constant growth. Constant growth. Constant growth dividend model. So what we mean is that although the dividend cannot be the same every year, but we are saying that the dividend will be growing by 10% every year. That is a constant growth. We know that in practice, dividend payment cannot be the same every year, because the dividend payment is based on the profit. So the more you make profit, the more dividend that you are going to be paying. So dividend payment cannot be constant, 10 cedi every year. It cannot be constant. It depends on the profit that you are making, the volume of the profit. But we also know that dividend can grow. But we are going to be saying that the growth should be the same, 10% every year. So we are going to be looking at constant growth dividends model to do that one. Then the next one we'll be looking at what we call the capital assets pricing model. Capital asset pricing model, which we call the CAPEP. Okay, for this one, it takes into consideration the risks that the entity is being exposed to, which is this one is a popular one that we use. Okay, let's come here. Let's use some application for time value of money. So let's come here. All right. Let's come to some situation here. We learned in Environment for Financial Management that shareholders' wealth are being maximized through two ways. We learned in Environment for Financial Management that the shareholders' wealth are being increased or are being influenced in two ways. Okay, what are those ways? We are saying that the shareholders' wealth have been increased by two different items. What are those items we look at under environment for financial management? Shareholders' wealth has been increased by two items. What are those items? Shareholders' wealth is maximized through two things. What are those two things? Okay, dividends and so it's going to be so shareholders' wealth are being maximized through dividend payments, and capital gain. Okay, the money that you are going to, the gain that you realize from the sale of the shares when the price increase. So you buy the shares at 2 cedis and you are selling at 2.5. You are getting 50 pesos per share. That is capital gain. Let's come here. Let's come here and apply something. Okay. Perpetuity. Have the perpetuity in your head. Okay. Let's come here. We are saying that, let's say that we are saying that if we bring a certain amount of money, now we are going to give you 100 cedis every year. Okay, if you bring a certain amount of money, it is going to be attracting you 100 cedis every year into the foreseeable future at a rate of 10%. What it means is that if you bring a certain amount of money now at 10%, okay, if you bring a certain amount of money now, which is going to be attracting interest of what? 10%. We are going to be giving you 100 cedis to infinity. How do you find that value today? If you bring a certain amount of money, we are going to be giving you 100 cedis at 10% to infinity. How do we find the value of that?
Bluetooth device is ready to pair.
How do you find that one? You are at 10%. If you bring a certain amount of money, 10%, we will give you 100 cedis to that kingdom come. How do we find the value of that amount that you are bringing today, which is the present value?
Discount the
If you bring a
10%.
certain amount of money today at 10%, it will give you 100 cedis every year to the kingdom come. These 100 cedis represent what? Is it annuity or perpetuity?
Perpetuity.
How do you find present value of perpetuity? How do you find present value of perpetuity without growth? How do you find present value of perpetuity? Okay, perpetuity present value is equal to perpetuity over here. It is going to be the present value of the amount that you are bringing. It is going to be 100 cedis divided by the rate, or 1 over 0.1 multiplied by 100 cedis. How much are you having? I'm sure that will be 1,000, isn't it? Would that be 1,000?
Yes, so it's 1,000.
Okay. Let's come here. Okay, assuming the amount that they are giving to you every year is dividends. Okay, so we are now on dividend valuation. Okay. So the cost of capital, we are just going to be using the application of the TT to get there. So let's come to the dividend valuation. Assuming they are now saying that what is going to give you a dividend when you buy the shares, isn't it? You only get dividend when you buy the entity shares. Do you agree?
Yes.
Okay. You only get dividend when you buy shares of an entity. Now, the shareholders or the management is telling you that whatever shares that you buy today, it is going to give you a dividend of 10%. But this not 10%, sorry, 10 cedis. Okay. Whatever shares that you are buying today, by virtue of buying those shares, we are going to be giving you a dividend of 10 cedis per share. But this dividend of 10 cedis per share, we are not going to be just be giving this one. We are going to consider time value of money. So this dividend of 10 cedis per share that we are giving to you, we are giving it to you because our cost of capital, our cost of raising, our cost of using equity. So the question will give you the cost of capital. That okay, the cost of capital, our cost of using equity is 10%. Okay, our cost of using equity is 10%. Okay, our cost of using equity is 10%. So what it means is that if we bring a certain amount of money for shares, we are going to be giving you 10% on that share every year, which is going to be giving you 10 cedis every year per share. So the question now, they are saying that this is 10%. Okay, so the meaning of this is very simple. If you bring a certain amount of money now at a rate of 10%, it's going to be giving you 10 cedis per share every year. If you bring a certain amount of money for a share now, it is going to be giving you 10 cedis per share every year. How do you determine the value that you are going to be paying for the share now? A certain amount for a share is going to at a 10 cedis. Oh, sorry. A certain amount of money at 10% is going to be giving 10 cedis every year into the foreseeable future. How do you determine the amount that is going to be giving you 10 cedis at 10% every year for the foreseeable future? How do you determine that value? How much are you bringing today at 10%? That will give you 10 cedis every year into the future, into infinity. How do you determine that?
And over the rate.
Okay, so that value, the value will give you the 10 cedi over what? The 0.1. Do you agree? Okay. So how much are you going to be paying for a share now at 10% so that you'll be able to get how much are you going to be paying for a share now at 10%? That will give you 10 cedis every year.
100.
100. This is not a share price. This 100 is a share price. So what I'm trying to tell you is that a share price of an entity can be determined by finding the present value of the dividend that you are going to be receiving. It is the amount that you are going to be paying today that is going to be giving you the dividends in the future. So they are saying that whatever amount that you are bringing today, we are going to give you 10% of it. That amount will give you 10 cedis every year for the foreseeable future. So that becomes perpetuity. For you to find the present value, it is going to be the cash flow divided by the discount factor. Now, let's come here. Okay, we now say that for us to find a share price or the value, to find the value of a share, okay, to find the value of a share, let's try to do this one. To find a value of a share with this particular example that we have done, to find a value of a share, it is, what do we do? 10, isn't it? 10 over the cost of capital. Do you agree? We have 10 over the cost of capital. Is that correct?
Yes.
In this particular question, the 10 represents what?
The dividend.
The dividend. So I can say the dividend, I will have the dividend. Then you can see that this cost of capital is relating to equity because dividend that brings equity. So I can say this is cost of equity. So I can now say that, okay, the price of equity share today is equal to the dividend per share every year divided by the cost of equity. If I want to find the cost of equity now, how do I go about it? Someone should tell me. How do I find the cost of equity? Is it going to be K multiplied by PO is equal to DO? And the cost of equity will give me DO over PO multiplied by 100. Do you agree? Look at the mathematics. If you want to find a KE from here, what I've done over here, is it correct? I'm having the cost of capital is equal to the dividend divided by the price. Then I'll do it 100% multiplied by 100 because what I have over here is 0.1, which is 10%. So I have to multiply the final answer by 100 to get my percent. What I have over here, is it correct? Using annuity to find the cost of capital from annuity or the discount rate. It is the same. This is what I have over here. KE is equal to the DO is the dividend per share of 10 cedis. Okay, and the PO is the value of a share of 100 cedis. Then multiply by 100, I'll get my 10%. So assuming I'm giving the 100, I'm giving the 100 cedis, but I'm not giving the cost of capital. From what I have over here, assuming I've been given the amount that I'll be getting, I'll be investing today, and I'll be getting 10 every year. And they say what rate at 100 cedis will give me 10 cedis. So I don't know the rate. So I'll come here and have the rate. If I want to find the rate will give me 10 over 100 multiplied by 100%. So the 10 over here is my core, is my dividends, which we represent as DO. And this is the value of a share, which is represented with the PO. So cost of equity is being determined from the perpetuity aspect. So if we come to constant dividend that is not growing, constant dividends, we come to constant dividends. Okay. If you come to constant dividends, okay, constant cost of equity using constant dividend. What it means is that dividend is going to be the same every year. Okay, the dividend will not change. It is going to be the same every year. We use the principles of perpetuity, which is going to be the present value. The present value is the amount that you are going to be paying for the share today. That will give you a dividend of 10 cedi every year, and they will give you the discount rate. So let's say this is 0.1. You are looking for a 0.1 now. So they will give you the 100 cedis. Then your 100 cedis will be equal to the dividend of 10 divided by the discount rate. You are looking for the R. The R is the cost of capital that we are looking for. So you just make the R the subject by having the rate is equal to 10 over the 100 multiplied by the 100% to have your 10%. So cost of equity, which we call the KE, or the cost of capital for equity, it is represented with KE. Then we come here and have the dividend per share, which is a 10 over there, divided by the price per share. This price is going to be SDIF price. Okay, I will explain that one to you. Multiplied by 100. We use 10. We use 10 cedi and 10% to get 100. Now we are giving the 100 and then the 10 cedi to find the 10%. We can do that one by doing change of subject. So we can get a 10% now using 10 cedi over the 100 cedi that we have gotten, multiplied by 100 will give us the 10%. So that's how we find the cost of the equity when the dividend does not change. They say constant dividend. The dividend does not change. It's the same dividend every year. So that making towards perpetuity. You will continue as a shareholder, as an equity shareholder, you continue to receive dividends as long as you remain the shareholder of the company. So you receive the dividend into the foreseeable future. Even if you are no more, your family will still come and enjoy that particular shares because you have investment there. But they'll continue to pay the dividend to you. So that will make the dividend payment a perpetuity. And they will give you the value that you have to pay today to be able to get that 10 cedis every year. And they're asking you, at what rate will you be getting the 10 cedi every year when you invest 100 cedis now? So that rate is what we are calling the cost of capital. So we have done that one. And the DO over here, the DO is the dividend per share, which is the current dividends. Okay, dividend per share, which is going to be the current dividends. Dividend per share, which is going to be the current dividends. Okay. Current dividends, current dividends, current dividends. Then we come to the PO. PO is the SDIV share price. Okay. SDIV share price. I will explain what we call the SDIV share price. Okay. SDIV share price is the share price after dividends has been paid. Okay. So let's look at that one. The KE is the cost of equity. How do we determine SDIV share price? Let's come here. Okay. All right. Let's come here. Let's assume that the share price of an entity, let's say is 100 cedis. The dividend that I have to pay per share, dividend per share. So the share price or the price per share, which is the share price, is 100 cedi. Okay. So the dividend is 10 cedi. Okay. If you are an owner of this particular, you own a share in a company. Let's say you just own one share. You own one share. If the company wants to settle you now, how much are they going to be giving you for the share that you own? What is the total amount? If you own just one share in this company, the value of a share is 100 cedis now, and the company will pay you a dividend of 10 cedis per share. If the company wants to settle you today, how much are they going to give to you?
110.
They will give you 110, isn't it?
Yes.
So they'll give you 110. For that 110, they will give you 100 cedis for the shares and the dividends, isn't it? Okay. So when would the company give you 110? When the company has not yet paid you the dividends. Do you agree? The company will give you 110 when dividend has not been paid to you yet. The company will give you 110 when dividend has not yet been paid to you. But if dividend has been paid to you, what is the price of the share? How much are you going to be giving?
100.
You'll be giving 100. Okay. So if the company has not paid a dividend yet, they will give you the 100 cedis for the share that you own, and they will give you the dividend in addition. But if the company has already paid dividends, they will just give you the share price, which we call the 100. So if you come here, a situation where the company is here to pay the dividend. So the company is actually telling you that, okay, every share that you own should be sold at 100 cedis. But since we are here to pay you a dividend, it means that we are owing you additional 10 cedis for a share. So whatever share that we are going to be, whatever amount that we are going to settle you, it is actually 110 because we are owing you 100 cedis for a share that you own in addition to the dividend. So they will value the shares at the share price itself plus the dividend value, because the share price will be given to you per share. The dividend will also be given to you per share. So in total, they are giving 110. And this is what we call the Kumdiv share price. The share price including what? Dividends for the year. But the share price of the company is not what? It's not 110, it is 100. So for you to get 100 as the actual share price, which we call the SDIV, you have to take the Kumdiv share price and take the dividend out of the Kumdiv share price. Then you now have the SDIV share price. So the question can give you Kumdiv. Kumdiv means the actual share price excluding the dividend that is yet to be paid. So the question will tell you the dividend declared but yet to be paid. It means that if we want to pay you, we will pay you the share price, the actual share price, plus the dividend that we are owing you. So we are valuing the shares because we are owing you dividends. So we are valuing it at Kumdiv. Then the question will give you the dividend payment. You have to find the value on the actual share price, because anyone who is coming to buy the shares will not be entitled to dividends now. So the person will be paying for the share, the person will be paying for the share, not the share price plus the dividend. The person is not there, so the person will not pay for the dividend. So we use the actual share price, which is the SDIV share price. So if you are giving CUMDIV, you subtract the dividends year to be paid for the current year from the CUMDIV and have the SDIV for the calculation. Okay, and have the SDIV for the calculation. So when you are giving CUMDIV, just know that dividend to be paid is part of that one. Take the dividend out of it to have your actual or the actual price, which we call the SDIV what? SDIV share price. Okay, let's come here. Let me bring some issues over here. Then we just go and try some questions on this one and move on. Okay. Let me bring some other issues over here. So let's come here. Some other issues. So let's come here to this one. So come to, okay, let me come here and tell you something. Okay. Let me come to the constant dividends. Constant dividend with issuing cost. Sometimes I can give you some issues with constant dividends with issuing cost. Constant dividends with issuing cost. Constant dividend with issuing cost. Okay. How do we determine the cost of equity? When you have issuing cost or any transaction cost, we can call it issuing cost or any transaction cost. Under IFRS 9, I hope you have heard about IFRS 9 before. Financial instruments. Please, have you heard about financial instruments before? I'm not going to ask you any complicated question. Have you heard about IFRS 9, financial instruments? Have you heard about IFRS 9 before? Financial instruments. So we don't have anyone here. Yeah. If you're just having first degree, unless you are coming from maybe UCC before you can hear about financial instruments, the accounting is a bit stronger. But if you are coming from Legon, UPSC too, okay, you can hear about financial instrument before. But if you are coming from Legon and Winneba to I doubt, okay, you might not hear about the financial instruments. Okay. So, okay, so let's assume that we are all coming from maybe UG, Winneba, and okay, we are coming from Winneba. Auntie Natalie, have you heard about financial instrument before? Hey, please, we are not here to do which of the school is the best or okay. Some of the school, their curriculum is based on the ICA one, and some of them they are not based. And some of the accounting or reporting teachers in some of the school, they are chartered accountants. So they decide the curriculum based on the ICA syllabus. Okay, so it doesn't change anything. If you want to know more stuff, you can do the professional course. So it's not their duty to teach you professional stuff. So please, we are not here to see which of the school is. All of them are okay. So let's come here. Yeah, Auntie Natalie, you have heard that. The place that you are, you can't talk, okay? Because I would like if you are exchanging maybe words with me. Can you talk, Auntie Natalie? I want to get some understanding from you. Yeah, I've seen we have before. Who again? I want to get an understanding from you. It's better we beat from there. Please, someone just own up. We will not ask you any question. We will not even kill you. Okay. We are all learning. Okay. So if you have heard it before, just let them. Anyone? I want the person to talk. Auntie Natalie, where she is, that she cannot talk. So please, let's hurry up. Okay, we are doing only 2 hours 30 minutes, so we have to do equity. I don't want to say, oh, this thing should be done like this. This should be done like this. No, that is not how we learn. Okay. Although at the end of the day, I will tell you anyway. Okay, please. I'm doing roll call.
Brain,
Yeah.
are you asking of what financial instruments are? I don't know.
No, I'm asking if you have heard about it before. So I'll ask the
Ye-
question.
Yes.
Okay. So if we issue equity, would the equity be settled in a short period of time? If we issue equity shares, is it going to be something that will be settled within a short period of time? Would it even be settled at all? Scenario, the question is for you.
For me,
Yes, please. If you issue equity shares,
okay.
is it going to be settled within a short period of time? Will it be settled at all in the first place? Equity shares, do we pay back?
Yes.
Equity shares, are they paid? Do you have to pay back as an entity?
Yes.
Equity shares or not? Equity shares, do we pay equity shares back? No. Equity
No.
are not debt, so we don't pay back. Okay. Now, if we issue financial instruments, do you agree that equity shares are going to be treated as financial instruments?
Yes.
Okay. If you issue financial instruments that are going to be for the long term and you incur transaction costs, how do you treat the transaction costs? Do we expense the transaction cost or we subtract from the money that we are raising? If it is an asset that you are buying, you add. If it is a liability, you subtract. Is that correct?
Yes.
Okay. If let's not worry. Let's assume that we all we don't have idea about the financial instruments. Don't worry. It'll be very fine. Okay. So let's come here. Assuming you are going to be taking a loan. Okay. And the amount of the loan that you are going to be taking is 20,000. And the bank is saying that you need to pay a processing fee of 1,000. Would the bank give you 20,000 and ask you to pay the 1,000 from your own pocket, or they will subtract 1,000 from 20,000 straightforward?
They will subtract.
They subtract.
They always subtract the processing fee from that particular one, isn't it?
Yes.
Okay, it means that the processing fee is a cost that you are incurring as a result of that one. So that should be an expense. The loan that the bank is giving to you, okay, it's a liability, but the expenses that you are making an expense, you are incurring a cost. So it is very simple. You should have been treating this part, you should have paid this particular one and treat it as an expense. Pay from your pocket and treat it as an expense. And go and take this particular one. At the end of the day, you are paying 1,000 for what? 20,000. So you are only receiving 19,000. So what the bank does is that the bank will subtract just the processing fee from this one. The bank is accounting for that particular item like financial instrument because the cost that you are incurring is a direct cost to the loan. So since it's an expense, instead of you writing it to profit or loss as an expense, no, you need to capitalize it because it's relating to an amount of money that will be paid over 4 years. So the loan should also be there. Expense should also be amortized or spread over 4 years. But since the processing fee is relating to the loan, instead of you treating it as an asset for 4 years, you just subtract it from a liability and have the net amount that you are going to be receiving. So what we do is we always subtract the issuing cost from then what? We subtract the issuing cost from the market value of the asset, or the market value of whatever we are receiving. So when you issue the shares, let's say you issue the shares for 10,000, and you're supposed to pay issuing cost of 500 to be able to raise this one. Indirectly, you are going to be getting only 9,500 from the issuing, because although you are getting 10,000, you are paying 500. So you are going to be getting 9,500. So what you do is, for you to find the cost of capital, you have to find the cost of capital, including the issuing cost. What it means is that how much should I pay the person so that I can be able to get the total amount that I want. So we'll be looking at that one anyway. So I'll come here. Whenever you have issuing cost, please, the issuing cost is deducted from the amount that you are raising. So if we should come here and find the cost of equity here from the first thing that we have done, it is going to be, I'll have the dividend per share over the market price per share minus the issuing cost. I'm using the F as the issuing cost. Then you multiply the answer by 100. So if there's an issuing cost, your cost of capital will be calculated by subtracting the issuing cost from this particular one. The question can give you the issuing cost as an amount of money. They can give you as a percentage. Okay. When they give you as an amount of money, let's see, let me just come here. Assuming the issuing cost is 2 cedi. Okay. So let's just try something here. So let's see, the dividend per share, which is DO, is actually 10 cedis into infinity. Then the market price per share, the SDIF share price is 100 cedis per share. Then let's see, the issuing cost now is what? Is 2 cedi. Our cost of equity will be calculated as 10 divided by 98 multiplied by 100. Do you agree?
Yes, that's correct.
Okay. Now, assuming they have given you this as 2%. Okay, you can decide to find the 2% of the 100. They will tell you that the 2%, the issuing cost is 2% on the what? On the market price. You can decide to find what? 2% of that. Someone can also decide to do this. I can decide to do, if I'm receiving 100 cedis, and 2% of it is issuing cost. How much in terms of percentages will I be returning? If I'm receiving 100 cedis, I'm paying 2% as issuing cost. How much am I going to be returning on percentages?
98.
I'll be returning 98, isn't it? Okay. So someone can just do the 10, then a person will do 0.98 multiplied by 100. Then the answer multiplied by 100. Do you agree? Do you agree that someone can do something like this?
Yes, yes.
Okay. Now, let's think about this one too. Do you think someone can also do something like this? The person will have 10 divided by 100 into bracket 1 minus 0.02 multiplied by 100. This 1 minus 0.02 is the same as 100% minus 2%. Do you agree?
Yes, yes.
Okay. So somebody can do this like this. So I can say now that when you are having the, so I'll come to cost of equity, okay, cost of equity with issuing cost without tax. Okay, sometimes the question will tell you the issuing cost is tax deductible. Okay, the issuing cost is tax deductible. So I will say without tax now. So it means that tax is not on it. We look at them one by one. If I do this one, if I'm doing the second one, we will not struggle with that one again. We just bring this one. So I'll come here, the person can do cost of equity like this. So the person can do DO into bracket, the PO into bracket 1 minus F. The 1 minus F over here is going to be the percentage rate for the issuing cost, like how we have over here, which is 100 cedis step share price. Then 1 minus what? The percentage rate. If the percentage rate is 5, it means that 0.05 give me 0.95. It means that if I'm receiving a certain amount of money, I'm receiving certain amount of money and I'm giving 5% out as issuing cost, I'll be returning 95%. And that 95% in decimals is 0.95. So someone can do it like this. So this is the issuing cost without tax, cost of equity, constant dividends, issuing cost without tax. Okay. Now, what if the question says that the issuing cost is tax deductible? Issuing cost is tax deductible. What is the meaning? Very simple. The question says that the issuing cost is tax deductible. When I say tax deductible, we are going to break that one down. So the question can say the issuing cost is tax deductible. What it means is very simple. Tax deductible means the tax authority will allow you to take the issuing cost from your profits before they will charge tax on it. Before they will charge tax on the remaining profit rather. So if you are incurring issuing cost of 2,000 for the year, the tax authority will allow you to subtract it. It is going to be allowable for deduction. So you deduct it from your profit before the tax authority will charge tax on the remaining profits. That's what we mean by tax deductible. So it will always bring us tax benefits. So let's come here to this place. Very simple. We are going to use the same principle for interest when we come to cost of debt. So let's come here and have two types of profit here. Okay, let's have two types of profits. So I have 2024 and I have 2023. So let's say we have the profit of 20,000. Okay, let's see the first one we have issuing cost for the second one. So let's see our issuing cost is 4,000. And this one, there is no issuing cost. So profit before tax will be 16,000 for this one and 20,000 for this. Let's see our tax now is tax is 25%. What will be the tax that we are going to be paying for 2024 and the tax for 2023? will be 4,000. Is that correct?
Yes.
Okay. And this will be 5,000. Is that correct? Okay.
Yes.
So this will be 12,000. And this will be what? 15,000. Let's look at the tax that we are paying. We are paying lesser tax in 2024 as compared to 2023. What do you think is the difference? The difference in the tax is 1,000. Do you agree? The difference in the tax is what? The difference in the tax that we are paying is how much? The difference in the tax that we are paying. I cannot hear you. If you're talking, I cannot hear you.
It's 1,000.
Where is the 1,000 coming from?
Please, can I hear you again?
Is that?
Sorry, please, I thought you called my name. Sorry.
So it means that you are not following what we are doing. Yeah,
No, sir, I just closed from work. I just closed from work, so I'm now packing my things to leave the workplace. That's why.
That's why maybe so all of us we are from work because our talks are nobody. Or we just join and we are doing different things altogether in Charlie. Because I was thinking we are all together. Okay, so let me also bring you along. That's why I'll bring the question, but nobody is there. All right. We are very fine.
Oh, yeah, sorry. I've joined now. I'm done packing.
Oh,
Sorry.
don't worry. I didn't mention your name anyway. Okay. But just that I'm just trying to realize the train that maybe all of us we are doing something together. Because if I say the things, it means like we are not following. Before I come and say it again before someone. So please, let's not do it like that. Okay. Let's come here. What is the difference? Okay, someone mentioned 1,000, and I'm asking, what is bringing the 1,000 difference? We are paying a tax of 4,000 in 2024, and we are paying a tax of 5,000 in 2023. Yeah, the difference is 5,000. What is making us to pay a lesser tax in 2024 than 2023? That is the question. What is the thing that is bringing the difference?
The issuing cost.
The taxable amount.
Which is the issue,
The
isn't it? Okay, you can see that in 2023 there is no issuing cost. So we are paying what? We are paying tax on all the 20,000. Okay, but you can see here we have the same 20,000, but we are not paying tax on the 4,000. But this one we are paying tax on the 4,000 over here because there is no issuing cost. So instead of us doing our tax like 0.25 multiplied by 16,000, okay, then plus 0.25 multiplied by 4,000. Do you agree that the tax for 2023, this is how it is computed? 0.25 multiplied by 16,000 plus 0.25 multiplied by 4,000.
Yes.
Okay. So we are having 4,000 here plus what? 1,000 here. But you can see that this 1,000 is now, this 4,000 is an issuing cost. So that 4,000 out of a profit, you can see that it is the 4,000 out of the profit that is covering the issuing cost. So that 4,000 of our profit, we cannot pay tax on it because the tax authorities are allowing us to keep that portion, which is we are using to cover the issuing cost. So you can see that the issuing cost is giving us a tax benefit of how much?
1,000.
1,000.
Okay. Now, how much are you going to be paying to the people that you are incurring the issuing cost to? You are paying 4,000, isn't it? You pay 4,000.
Yes.
But the issuing cost is giving you a benefit of how much?
1,000.
1,000.
So in effect, how much are you paying?
3,000.
You are paying 3,000. Okay. So we don't use the 4,000 as the issuing cost, as the total issuing cost, because the issuing cost will be subtracted from your profit. So it's going to give you a tax benefit. So we look at the net amount that we are paying. What it means is that although we are paying 4,000 to the where the issuing cost, we are paying 4,000. But this 4,000 is reducing our tax by 1,000. So we are receiving a cash benefit of 1,000 from the tax authority whilst we are paying 4,000. So indirectly, we can see that we are paying only 3,000 and the tax authority is paying 1,000 because we are going to enjoy tax benefit of 1,000 from the issuing cost. So we don't use the 4,000 as a total amount. We use the net amount after tax amount. So when the question says this is going to be tax deductible, or the question will say issue cost is tax deductible, then how do we now calculate our cost of capital? That is what we are going to be looking at. I won't do it for constant dividend or dividend with constant growth because whatever I'll put over here is the same thing as we are going to be implementing in the second one. So I will not do that one. I will not go to explain it like this again. So if we do it for this one, we just move on. Now let's come here. Okay, let's come here. Let's say that our dividend per share, which is DO, okay, at the same density, then our price per share is 100 cedis. Then let's say our issuing cost. Our issuing cost is now, let's say, 2 cedis. But they say it is tax deductible, and the question is giving a tax rate of, let's say, a tax rate of 30%. So the question is saying that the tax rate is 30%. Okay, let's come here. What is the tax benefit that we are enjoying? It's 20%, it's 25%. We are enjoying a tax benefit of 25% on the issuing cost. Do you agree? Over
Yes,
here.
please.
Okay. If the tax rate is supposed to be 30%, you will see that you are not going to be paying tax of 30% on the 4,000 of the profit. Do you agree?
Yes, please.
Okay, so it means that you'll be enjoying 30% tax benefit. So whatever the tax rate is, you are going to be enjoying what? That particular tax benefit. That portion of your profit, you won't pay that tax on it, which is relating to the issuing cost. So we can come here and say that the only amount that we are paying to the people is 75%, because the tax authority will take care of 25%. Because if we pay the 100%, it will give us a tax benefit of 25. So indirectly, on a net, we are paying 75. So somebody can come here and say we are only paying 3,000 to those people, which is the 3,000 that we are determining first. So let's come here. Okay. They are saying that you are going to be enjoying issuing cost. Issuing cost is 2 cedis, and you are going to enjoy tax benefit of 30% on it. So indirectly, how much are you paying? How much are you going to be paying? How much will the company be paying in terms of percentages?
70.
The company will be paying 70% of the 2 cedis. Do you agree?
Yes.
Because
Yes.
if we pay 100%, we are going to enjoy a tax benefit of 30. So indirectly, we are paying 70%. So you come here, your cost of equity based on this example will be determined as the 10 cedi, which is the dividend per share, divided by. So you come here, your 100 cedis. Your 100 cedis will now be something like this. So come here, I'll have my 100 cedis minus what? Let's do that one. That will be 0.7 multiplied by 2. How much are you having?
1.4, I'm sure.
1.4.
1.4.
Okay, so that will be 1.4. Then multiply by 100. Instead of you subtracting the 2 cedis, okay, you only subtract the 2 cedis when you are not going to be enjoying tax benefit. It means that you pay the 2 cedi flat without any benefit. But if you are going to enjoy tax benefit, you pay the 2 cedi flat, but you enjoy a tax benefit. That tax benefit will be cash savings, which you can see here. We are saving cash of 1,000. Instead of us paying 5,000 in the 2024, we are paying 4,000. We are saving a cash of what? 1,000. That cash we are going to be using to pay the issuing cost. So indirectly, we are going to be removing another cash of 3,000 added to the cash that we are saving to pay that particular one. So we are paying only 3,000. So the same way, 2 cedi out of your profits, 2 cedi per share out of your profit, you are not going to pay tax on it. So you are going to be saving the cash that you have been paid as tax on that particular portion. So you are not paying it, although you are paying 2 cedi, but you are going to be enjoying a tax benefit of 30% on 2 cedi. So you are going to be saving the cash of 30% on the 2 cedi. So indirectly, you are paying 70%. So we only use a 70%. Now let's come here. Assuming we are having 2%, our issuing cost is 2%. Let's assume that our issuing cost is 2%. Okay, our issuing cost is 2%. This 2%, our benefit will be calculated as 0.02 multiplied by 70 multiplied by 100. This will be having 1.4. Do you agree? We'll be having the 1.4 as the amount that we are paying. Do you agree?
Yes, please.
Okay. Now, we don't want to calculate this on the what? We don't want to calculate this on 100 cedis. Okay. You can see that we are going to be having 1.4% as the amount that we are paying. Do you agree? 2% is the full amount. But on that 2%, we are going to enjoy 30% tax benefit. So we are going to be paying only 70% of the 2%. Do you agree?
Yes, please.
What would that give you? Would that give you 1.4%?
Yes.
Okay.
Yes.
1.4% on what? 100 cedi, isn't it?
Yes.
Okay. So out of the 100 cedi that we are receiving, how much are we keeping? We are paying 1.4 as issuing cost. How much are you keeping?
98.6.
So can we say that our cost of capital also over here is going to be 10 over 0.986 multiplied by 100?
Yes.
Okay. Now let's come here. It's not easy. Let's come here. We say that this particular, okay, for me, I believe that you should understand. If you understand, you don't have any issue. Because I don't know whether you also have the aim to teach. Okay. So if you want to teach, you have to understand. So that is why we can go straight forward. But if you understand, maybe the things are plenty. So the only way that you can keep them is to understand. So don't worry me. If I'm worrying you, it's for our own good. Don't worry. Okay. Now let's come here and determine this 0.98. Okay. Can I say that this 0.98 can be determined as 10, 100 into bracket 1 minus 0.014. 100 multiplied by 0.98 can be determined as 1 minus 0.014, which is the amount that we are paying out of it. Are you getting the 0.986 again?
Yes.
Okay. Now, where did we get a 0.014? It is determined as the 2% multiplied by 70%. Do you agree?
Yes.
Okay. 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 How did we get a 70%? 70% is determined as subtracting 30% from 100, isn't it?
Yes.
Okay. So we can do, okay, I can do now 2%
Senior.
by 1 minus what? 0.3. So I have the 1 minus 0.3. I'm just changing this one to numbers. So it's supposed to be 100% minus 30% to get a 70%. But I don't want to have it percent. I want to have it in number. So this will be divided by 100. Divided by 100. So I'll be having 1 minus 0.3. So I'm doing it in number, not in percentage. Now let's incorporate this now. I'll write one as one item. Then you just think about it. Okay. So I'll come here. If it is with tax. Okay. So now let's come here. We are having with tax. Okay. If we have this one, the issuing cost is tax deductible. Okay. Tax deductible. Tax deductible means the tax authority will allow you to subtract it from your profit, and they will charge tax on the remaining figure. Okay. So I'll come here. I'll have the P is equal to the dividend per share will be at the top. Look at this. I'll have my P. Then I have into bracket. I'll have 1 minus. I have another bracket here. Then I'll have F 1 minus T. Okay. Don't worry, we break it down. Okay. Then I'll have equal multiplied by 100. So I'll have this first. I'll do this one first for the last one. Okay, let's break this down from what we have done. Okay. We know that. So let's break this one down from what we have done. I'll have the 10 over here. The top is not a problem. Then I'll count to 100 here. I know the 100 should be 100 into bracket 0.986. That is the portion that we are returning. But I want to do that. So I'll have 1 minus, then I'll come to the bracket here. This should give me, the F is the issuing cost percentage. So I'll come here 0.02. Then I'll have the 0.02 should be the total amount that I'm paying, but it's giving me a tax benefit of 30%. So I'll come here and have 1 minus the 0.3. So I'm going to be paying only 70% of that. So if I do it, I'll have 1 minus into bracket. I'll have my 0.02 multiplied by 70%, which is 70. Then the answer that I will have over here will be 1 minus into bracket 0.014. Then I'll be having my 0.986 multiplied by the 100 outside. How we have it over here. Okay. So I'm doing this because sometimes the question will not give you the issuing cost, they will give you in percentages. So you have to find the proportion of the cost that you are going to be returning after the issuing cost. So this is how we have it right here. This is the difficult part of it. Aside this one, there is nothing in it. Okay. Now I can now easily take this one off here. We have my figure here.
Brain.
Yeah.
So, would you be correct? Please go back to the.
Yeah, no, let me clean this one. Then I'll get back to you. Yeah, senior, let's move on. Will I be? Yeah, scenario.
Will it be correct if
Yeah.
in the insertion of your figures into the formula? Yes, can you hear me?
Yes, I can hear you.
Can you hear me?
Yes, please.
Good. Would it be correct if you insert the 70%, okay, or the 0.7 at where the 1 minus t is,
Yeah,
without you
you will
bringing in
not
the 1 minus
you
0.3?
will not be wrong because at the end of the day, it will still give you the 70%.
Okay,
Okay, so you can insert the 0.7 there,
that's
multiply
fine.
by
Thank you.
2%, and just subtract it from the one. That will also be straightforward for you. Okay, so it's all about working smart. Okay, so most of the time, if you see any book that you are using, this is how they write it. Okay, so that you not be confused. Let's come to dividend with constant growth. So what we have done, okay, let me say something here. Those of us that we are doing financial reporting, okay, what do we calculate like this? Dividend over the market price multiplied by 100. Dividend per share over the market price per share multiplied by 100. What ratio do we calculate like this? Investment ratio.
Price earning.
No, it cannot
Price
be,
earning.
it cannot be price.
Earnings per share. Earnings per share.
No.
Yes.
Dividend per share over market price per share multiplied by 100. Hey, my people. Price earnings is market price per share over earnings per share. Earnings per share is profit after tax divided by number of shares. So it's not the same. Yeah, it's dividend yield. So if you count to cost of capital with constant dividends, the cost of equity is equal to dividend yield. This is the same as dividend yield. Okay. So it is same as dividend yield. Okay. And let's come to dividend at constant what? Growth. Okay. Dividend with constant growth. With constant growth. Okay. Now let's come here. We are still going to be using perpetuity. Okay. They are saying that if you bring a certain amount of money now, okay, if you bring a certain amount of money now, it is going to be giving you a cash flow of 10 cedis subject to a growth. Okay, let me say, if you bring a certain amount of money now, you will get 10 cedis at the end of the year, but this will grow at, okay, the amount that you are getting today will grow at, so let's say the growth rate is actually 5%. And they say the cost of capital today, let's say is actually 20%. So they are saying that if you bring a certain amount of money now, at the end of this year, it will give you a cash flow of 10 cedis. But that cash flow will grow at 5% into perpetuity or into the foreseeable future. And the cost of capital is what? Is 20%. How do you calculate the value of this particular amount that you are bringing to me? How much will you bring to me? That will give you 10 cedis at the end of the year. And these 10 cedis will grow at a constant rate for the foreseeable into infinity. And the cost of capital on that particular amount is 20%. This is just about perpetuity at constant growth. How do you calculate present value of perpetuity at constant growth? Present value of perpetuity with growth. It is the cash flow multiplied by 1 over the rate minus G. You are there?
Yes.
Can you remember something like this? Okay, that's something that whatever we are doing is just a build up from what we have already done. If you mix a lesson, these are from time value of money. And you can see that we are done with time value of money already, and we are doing this. This is still application of the time value of money. So your perpetuity with group, this is how we calculate it. So the issue is the 10 cedis that you are going to be receiving is actually the dividends. You receive dividends of 10 cedis today, but this will be growing at 5% every year to the into the future. There is no way that you stop receiving the dividend. So the amount, if you bring a certain amount of money today, that amount at 20% will give you 10 cedi, but this 10 cedi will be growing at what? At 5% into infinity. So this is about perpetuity. So you just have to find the amount today. That amount today is the amount that you are paying for the share. So they are saying that if you pay a certain amount of money for a share today, at the end of the year, we pay you 20% on that amount, but that amount will be subject to a growth rate of 5% every year. So what is that amount? The present value over here is the value of the share that we are looking for. So the question will give you the value of a share, which is the amount that you are investing today to get 10 cedis, and the 10 cedis growing at 5%. They want you to find what rate will give you the 10 cedis today, which will be subject to the 5% every year. So let's find the present value and try to find the rate rather. So we come here, I'll have the 10 over here multiplied by 1 over 0.15. What are we having as the present value, which is the value today? How much are we having? 10 divided by 0.15.
0.67.
60.67, isn't it?
Yes, yes.
Okay. So now the question will give you, so the market value of a share, the amount that you are paying for a share today to be able to get 10 cedi subject to 5% increase is 66.67 at 20%. So the question will now give you this 66.67 now and ask you to find the rate. Okay, so they will give you the market value now, which is going to be the value of a share, PO, which is the market value of a share by present value, the amount that you are going to be receiving. It is the dividend. When you buy a share, that is why you are going to receive dividends. So the present value of all the dividend that you receive over the future is equivalent to the amount that you are going to be paying for the share. So they can also ask you to find the share price of an entity, and they will give you dividends for so many number of years. It means that you are bringing a certain amount of money at a particular rate that is giving you 10 cedi every year. So that 10 cedi is having a time value portion. Just remove the time value portion from it by present value, all those amounts. So we pick a question where they will ask us to find a share price using dividend valuation model. We just present value all the dividend payments and find total it and have our value as the market value of a share. We'll be doing that one shot. So the question will give you this value, and they will give you the 10 cedi, and they will give you the 5 cedi, but they will ask you to find the cost of capital. So the value of a share today is 66.7. At what rate will you get 10 cedi at the end, which will not be subject to 5% increments? At what rate? That rate is not the cost of capital. So what rate that if we use it, 10 cedis perpetuity at a growth of 5% will give us 66.67. So that is the rate that they're asking you. So they have given you 66.67 now. So you will now come here and say that, okay, your cash over here is a dividend. Cash flow is a dividend. Dividend is actually a cash flow because it involves cash payment. Then you come here and have this particular one divided by the cost of equity minus the gene. What is the gene coming from? Okay, let me come here. This particular dividend is at the end of the year. So the dividend is at the end of the year. Sometimes the portion will give you the dividend at the beginning. So you increase it. Okay, so we are using dividends at the end of the year. But if this is the current dividend, this is the dividend now. Cash flows are assumed to be arising at the end of every year. So if the dividend now, you have to increase it to the dividend at the end of the year because we find present value a year from now. So if you're using the current dividend, it means that the dividend is now. You cannot find present value of this one. You find present value of figures that are going to be a year from now. So you have to come and increase this by 5%. If this is a current dividend, you increase by 5% to have 10.5 as a dividend. So we are going to be using the current dividend. So I will increase the dividend over here by, or increase the cash flow by the 5% to have the cash flow at the end of the year. But I use the 10 cedi as the dividend at the end of the year. But mostly the question will give you a current dividend. So you have to find at the end of the year dividend by increasing it. So I'm increasing this side. Okay, now we are looking for KE here, which is the cost of equity. We have been given the 66.67 as the price of the share, and we are giving dividends. And the question will also give you the growth rate. We want to find this particular figure. So if I do change of subject, I'll be having the KE minus this one, then I'll have DO, then 1 plus G, change of subject. Okay, I'll have all this one through by, I'll have KE minus the G, then I'll have I'm looking for KE, sorry. This one is wrong. So since I'm looking for KE, I have to find this one now. So I'll be having, look at this one, I'll be having PO multiplied by KE. I will find that one. So I have PO G is equal to DO 1 plus G. Then I'm looking for KE now. So I can make KE the subject here. So how do I make KE the subject? I'll have PO into bracket KE. Okay. Then I will now have equal to, I'll have DO. The DO, then I'll have 1 plus G. Then all of this will be plus PO G. Okay, so I'm looking for KE, so I can divide through by PO. So I have my KE is equal to DO 1 plus G. Then I'll have this divided by PO. Then I'll come here plus PO. Then this is divided by PO. So this and this will cancel. So I have my cost of equity now to be PO into bracket 1 plus G divided by PO plus the G here. Then all these answers multiplied by 100. So whatever cost of equity that we are getting, it is from the principles of time value of my perpetuity. All of them is for the perpetuity side. So our cost of equity from constant dividend with growth, or dividend with constant growth. This is how we calculate it. So I'll come and write it over here for you. So I'll come here. The calculation of that particular one is going to be KE. So I have my KE here, cost of equity is equal to the current dividend. We are looking for the dividends at the end of the year. So the current dividend has to be increased by the growth rate to have the dividend at the end of the year. Then divided by PO, then plus the G, then multiply by 100 to have the percentage. So the question now is, how do we calculate the growth? Okay, the DO is the dividend per share, the current dividend per share. PO is the SD market price per share. And the G now is the growth in the dividend. So how do we estimate the growth? The growth can be estimated, estimating growth. So the growth is actually estimated using estimating the dividend growth. So the growth can be estimated by using two approaches. The first one, we use train analysis. So how do we do the train analysis? Very simple. The train analysis is a question will give you dividend over a period of years. So they can give you dividend over the last 5 years, including the current dividend. So what you do is your growth is going to be determined as we have the growth is equal to, so this one, you can see square root somewhere, but because of some people, they find it difficult to find the square root, whatever I'm not saying that you can just go and press square root on your calculator. When they say something like this, the fifth root, so when they say the fifth root of, let's say 10, a number multiply itself 5 times will give us what, 10. So you have to point this in your calculator, not 5 root 10. it is called fifth root. So the number is going to be in the root like this, fifth root. So some people, they find it difficult to be able to press something like this on the calculator. So I use the principle of indices. So whatever you do over here, listen, we know that square root of A. Square root of A is the same as this one. Someone can say 2 root of A. But since this is a square already, we don't bring this one. So we can also have, someone can say we have cubic roots, which is 3 over here, A. So it means the number multiply itself 3 times will give us what? Will give us the A. So in indices, square root of A is written as 1 over 2, which is the same as A exponent 1 over 2, which is the same as something like this. So 1 exponent 2. So it means that this will be 1 exponent 3. So if you have 4, it will be A exponent 1 over 4. So I use the indices to do this one. So it is actually looking like this, but we write it in the indices format. So we come here, it is going to be the current dividend, okay, or some people call it the final dividend. So we have the current dividend is a current year dividend. Then you have the initial dividend. Initial dividend is the old dividend starting the year, I will tell you. Okay, the old dividend or the first dividend. So if you have 2021 to 2025, the current dividend will be the dividend for 2025. And the initial dividend will be the dividend for 2021. Then you come here, exponent 1 over n minus 1. All the answer that you get will be in decimal. So you multiply by 100 to have that particular one. So you can also see, if you are using other books, see something written like this. Okay? But please use the one that I've written, because of you will find it difficult to calculate or to press this on your calculator. It is actually like this. It is actually like this. It is actually like this. Then you have the current dividend, or sometimes you see, you can see D1 divided by DO or something. So they use the DD to represent the current dividend and then the initial dividend. So where I will use the current dividend and the initial dividend. But let me make the square root very simple. I have n root of current dividend. Current dividend. Okay, this is used to calculate any growth over time. It can be earnings growth, it can be dividend growth, it can be share price growth, any of them. So we can have the current dividend over initial dividends. Then this minus 1. Then all the answer will now be multiplied by now be multiplied by 100. So the only thing that I did over here is to change the root to 1, because we know that in indices, any number over here is whatever you have in the square root over here is what in the square root exponent 1 over that particular one. So it's going to be 1 over n. The n is number of growth experience, number of growth experience, number of growth experience, or let me say number of dividend growth experience. Okay. Or let me just say number of growth experience. I will explain that one. Okay. Let's come here and deal with that. Okay. So let me see number of growth experience, and we demonstrate something like that. Okay. Number of growth experience. Then let's come here. Just take it like this. Assuming you have been born in 2021, all things being equal, when are you going to be 1 year old? Or when are you going to be a year old?
2022.
2022. In 2023, how many years old are you going to be?
Please 2.
2 years.
2 years. 2024, how many years old are you going to be?
3,
And 2025, how many years old are you going to be?
4,
What is the number of growth that you have experienced over the years?
4.
4.
So the same thing that we do for the dividend. So they can give you dividend for 2021, 2022, 2023. For us to determine a growth, it is going to be 2 years from this one to one. This is 1 year of growth, 2 years of growth, 3 years of growth, 4 years of growth. So the N over there is the number of growth experienced over the years in the dividend. Okay, so you just pick your current dividend. They will give you information on the dividend. So your current dividend is going to be the current year dividend, which is 2025. And your initial dividend is going to be the 2021 dividend. Then the growth, you can calculate the growth. That is all. Then you just move on. Okay. Some people, okay, we also use the second one. The second one, how to estimate the growth. Now we use a Gordon's growth model. So the second one is we use the Gordon's growth. Sorry. We use the Gordon's growth model. How do we determine this one? Okay. The Gordon's growth model, he is saying that the growth is determined as the retention rate of the entity by the return on equity. So over here, we have the retention rate. The B is the retention rate. I will tell you what we mean by retention rate. Okay? Retention rate of the entity. And the R is return on equity or return on capital employed. But this is going to be return on equity. Okay. So since we are doing cost of equity, it's supposed to be return on equity. So the return on equity. So they are saying that for you to be able to find a growth rate, look at the percentage of the earnings that the entity is returning. So the retention rate is very simple. If we make a profit of 100 and we are paying 40% our dividends, what is the percentage that we are returning?
60.
We are returning 60. Okay, so the retention rate is a proportion of the profit that you are returning. And the return on equity, we know how to calculate return on equity. Profit after or profit attributable to ordinary shareholders over the equity fund multiplied by 100. But they will give you the return on equity. The question will give you return on equity. So they say that just multiply the retention rate by the return on equity. The question will give you information on the retention rate. But the return on equity, you are not doing accounting that you have to calculate return on equity. So they will give you just a percentage for the return on equity. Then just multiply the retention rate by the return on equity and get your growth. Okay, there are criticisms level against this way of determining what cost of equity using dividends. You see, we are just saying that dividend is going to be constant. In the normal circumstances, dividend cannot be constant because dividend payment is dependent on the profit that the entity has made. So dividend cannot be constant. Dividend will grow, but the dividend cannot grow at a constant rate. So what you are saying that the dividend is growing at a constant rate is something that cannot happen. And what you are looking at, we are just looking at the dividend payment, the amount of dividend that the entity can pay. We are not taking into consideration the risks associated with the securities of the entity. If I buy this particular item now, okay, are the shares of the entity trading very well? What is the chances of the shares increasing? What is the chances of the entity collapsing? We have not taken into consideration those risks, but we are just saying that we are going to be paying a constant dividend. So the dividend payment does not take into consideration the risks associated with the entity, but we are saying that we pay a constant dividend. So they are saying that no. Cost of capital for every investment should be influenced by the risks associated with that investment. But using dividend growth, you are just saying that I'll give you 10 cedis as a dividend every year. What if I haven't made a profit of that one? I'll still give you 10 cedis. It doesn't make sense. It does not take into consideration the risks associated with the operations of the entity. Therefore, this particular measure of cost of equity It's not appropriate because it does not take into consideration the risks associated with the equity instrument itself. So we need to find a way to determine the cost of equity that takes into consideration the risks being faced by the securities of the entity. So in that case, we move from this one and look at what we have, the CAPM. So the CAPM is the most popular one, but very simple. You don't have to stress. Okay. So you always pray that it will give you issue about CAPM. So we have the second one, which is going to be what we call the CAPM. So let's do the CAPM. And we pick questions now to do the other stuff. So I'll come here. I have the second model, which we call the capital asset pricing model. This one takes into consideration the risks associated with the securities of the entity. And the risk is always determined by what we call beta. Okay, so we are going to be looking at equity beta, asset beta. So what is equity beta? What is asset beta? We are going to be looking at that one. So we come here. We have two types of risks under this. So we have systematic risks, and we have what we call the unsystematic risks. Okay. So we use only one of them. One of them is, this one is entity specific. What do you mean by entity specific? What it means that this risk is only affecting the securities of a particular entity. Can you avoid that risk? If the risk is associated with investing in owning the shares of MTN, can you avoid that risk? How do you avoid the risk? They say the risk is affecting only the securities of MTN. Can you avoid that risk?
Yes.
How do you avoid it? How do you avoid it?
You avoid by not investing in MTN. You choose another entity.
So you can avoid by diverting your investment to other entities. So unsystematic risk is not taken into consideration before determining the cost of equity, because we are going to determine the cost of equity, or we are going to determine the risks for all the companies in that particular industry. So if you are operating in a Ghana stock exchange market and you are within the hospitality industry, we are going to determine the risks affecting the hospitality industry. We are not going to be determining the risks affecting only your entity. No. Anybody who wants to invest in the hospitality industry, what is the risk that you have been exposed to? So we determine the risks for the industry, not the entity. So if it can't be a systematic risk, are the industry specific, or it can be the security specific. The entity specific is that it's going to be affecting the security of one entity. But the industry specific is that it is affecting all the security that are issued on that particular market. So it's going to be affecting everyone in that particular market. So it can be the market specific, or entity specific is affecting only the securities of a particular entity. But if it is industry, it is affecting any security that will be issued in that particular market. So if you're looking at hospitality industry, any security any shares or any debentures that are issued by entities that are trading in the hospitality industry, they are going to be faced with that particular risk. Or all securities that are going to be traded in the primary market, the risk is going to be affecting them. None of the risks will be affecting only securities of a particular company. Whatever the security will be, or whatever the entity is, all the people in that particular category, the risk is going to be affecting them. So you cannot avoid it. The only way you can avoid it is that you don't want to invest. If we are saying that if you take the Ghana Premier League, for instance, most of the teams, they don't have what? Or the Ghana Premier League itself does not have sponsorship. So whether you want to invest in Ashanti Kotoko, House of Folk, or Hawkway United, or whatever, the risk of the league not having sponsorship will affect wherever you are taking your investment to. The only way that you can avoid it is what? You don't invest at all. So the systematic risk is affecting all the securities, all that type of security. If it is equity shares, it is going to be affecting all the equity shares on that market. If it is debentures, it's going to be affecting all the debentures on that particular market, not a debenture of a particular entity. So we determine the risks for the industry as a whole, or the market, or the securities on the market as a whole. So we use systematic risk in determining our risk factor, which we call the equity beta. We have asset beta and we have equity beta as well. But I'll be use equity beta here. I'll be explaining that one, especially when we are doing cost of equity specific for a specific investment. We'll be doing that one too, maybe Thursday. So we use systematic risk. Systematic risks affect all the securities or a book or a class of securities on the market, or it affects all the securities that are being issued on the market, or it affects the industry, the entire industry, or the entire market. Someone can say entire market or entire industry. It affects the entire market. If debentures are going to be affected with the risks, all the debentures in the market will be affected. Not only the debenture of MTN will be affected. So we determine the risks for the market or the industry as not a specific item. So we don't use unsystematic risks, but we use what? We use the systematic risk affecting all the securities on the market or the entire market. Then we use risk-free rate of return as the basis for determining our cost of equity. So I'll look at that one. We are going to be using equity beta for our calculation. The equity beta is the risk affecting the market as a whole and the risk affecting the entity as a whole. So the risk that we are going to determine over here, it is going to be what we call asset beta. The risk that we determine for the market is going to be an asset beta. But if the risk is affecting the market, you might have your own specific risk. The risk is just affecting the market. But if you are having more debt than equity, that is a risk that is going to be affecting you alone, not the entire market. So you have to also incorporate your risks into the risks on the market to be able to have what we call the equity beta. So we use equity beta. Asset beta is affecting a specific industry or a specific market. The equity beta is the risk that is affecting you as a company, your capital structure, at the same time operating in the space that you are. So equity beta is having the business risks or the operational risks as well as the financial risks. But asset beta is having only the operation risk. Asset beta, the risks associated with operating in that particular industry. But if you come to equity beta is having the risk operating in that particular market or industry plus the risk that you are affecting as an entity alone because of you having more debt than equity. Okay, so we use the equity beta here. The question will not tell you, they will just give you the equity beta. They will give you the equity beta straightforward. But the basis for determining this particular amount that we are going to be paying to the shareholders or the investor depend on what the government is offering. So let's come here. Okay, if Treasury bill is giving 8% annually, if you invest in Treasury bill, do you have any chances of losing your money?
No.
Okay.
No.
Now, if you want to invest in a private entity and they are offering you 8%, will you take it?
No.
Where will you send your money to? You either put it in Treasury bill, isn't it?
Yes.
Okay, why won't you take the private entity at 8%?
You can lose your money.
Okay, it
That's
means
it.
that the risk is higher than that of what? That of the Treasury bill, isn't it?
Yes.
Okay, what would the private individual does before you be able to accept his investment?
The private individual will give you a higher rate.
Okay, it means that the person has to add something to this one, isn't it?
Yes.
Okay, assuming the person is adding 4% to this. That will give you 12%, isn't it?
Yes.
So you go for the 12%. Okay. The person is giving you this particular 4 because of the risk being exposed. So we call this one risk premium. Okay, the additional 4% that you are enjoying is because of the risk. The person want to compensate you for the risk that you are going to be faced with what? With investing in that particular entities or securities. Because if you go to a bank, it's risk-free. If you go to Treasury, it's risk-free. So you can invest at 8% and get your money back. But since you are going to be exposed to a higher risk of losing the money, I need to now compensate you for that risk. So we call this one risk premium. Okay. But since we are determining the return on the market, what we do is very simple. Okay. Now let's come here. If the risk-free is 8%, what the market or what the government security, risk-free will always be the government security. If risk-free is 8%, and the market, what do you mean by the market? We are determining the risk for the entire market. So the entire market is giving 12% on every equity. The entire market is giving 12% on equity, but the government is giving 8%. You can see that the entire market is for the private security. So we can say the stock exchange market is giving for the private security. You can say the market is giving 4% in excess, isn't it?
Yes.
Okay. You see that 4% that the market is giving, it is actually for the entire market, which the entire market assume that the risk level is normal or the risk level is neutral, which means that it's 1. It is determined for all the entities in the market coming together. So that particular risk is determined for the market, which they assume that the market is what is normal. The risk level is 1. So it means that the risk level is cool. Okay, there's no issue of what excessive risk in the market. But you are not issuing this particular one is for all the securities on the market. You are not issuing all the securities on the market does not belong to you. So you cannot say that since government is giving 8% and the market is also giving 4% on it, so I will give you 12% because in the market they are giving the average rate is what 12%. So I'll give you 12%. The market is using what the government is giving. So if the government is giving 8%, I need to be able to add something to it because you will go for the government more. So for me to convince you, I need to add something to what the government is giving. So we use the risk-free rate of return to determine our basis for the return. Because the government is giving 8%, you have the option to go for 8%. So if the government is giving 8%, then I need to give 10% because I need to compensate the person for the risk that he's taking. So I'll use the government's 8% as a basis to determine my rate. So the market is saying that since government is giving 8%, we determine that the risk level is normal, therefore it will be 4%. So the market is saying that we are going to give it 12%. So the market is giving a risk premium of 4%. This means that the risk level is actually 1. The risk level is 1. So the market is giving 4% for 1. But if your risk level is 0.8, will you be giving the same premium as what the market is giving? If your risk level is what? Is 0.8, are you also going to be giving the 4 as a risk premium? Are you going to be giving the 4? The market is giving 4% for a risk level of 1. If your risk level is 0.8, are you going to be giving the same 4% on the 8% to have 12 for your security?
No.
What would be the
You give
additional rates that you'll be giving?
additional 4.
So you have 8% plus what? What would be the additional interest rate that you'll be giving for the risks that the person will be exposed to? If you have 0.8 multiplied by what? Please, the 4% is 1. Okay, so if 4% is 1, would 0.8 also be 4? What would be the 0.8? What would be the risk for the 0.8?
It's
3 points. 3 point what, please? 0.2 multiplied by percent. What are you having, please?
$3.2.
So how much are you going to be giving to the person to invest in your securities? What will be the total return that you'll be giving to the person? How much are you giving in terms of percentage to the person? Government is giving it, and the market is giving additional 4% for a risk level of 1, but your risk level is actually 0.8. So you give what the government will be giving because the person has the option to go for the government loan. So you have to add something to what the government is giving. So if the market is giving 4% and your risk level is actually 8%, you just add 0.8 of what the market is giving in excess to what the government is giving. Then you'll be giving the person 2.2% as a return on the equity. So that's how we determine the capital. So we use a government loan because the person has the option to go for a government loan. So you have to add something to what the government is giving. How do we determine what we have to add? We look at what the market is giving in excess. The market will be giving whatever they are giving for a risk level of what? Level of 1%. So if the market is giving 5% for a risk level of 1, and your risk level is actually 1.5, your risk level is 50 times higher than that of the market. So you have to give 50% times higher than what the market is giving. So you will be giving 7.5 in excess to what the government is giving. So you'll be having 15.5. Okay. So how do I determine this? I have what we call the risk-free here. The 0.8 is called the equity beta of the entity. Then I'll have 4% is determined by what the market is giving minus what the government is giving. That's why I have the 4% because the market is giving 12%. The market is giving 4 in excess to what the government is giving, which we call the risk premium. Okay, so the question sometimes can give the risk premium. The risk premium is this one, market risk premium. Is what the market is giving against what the government is giving. The market is giving more because of the risks associated with the securities. So if you count the cost of equity for capital, very simple. It is determined by what we have over here as cost of equity is equal to the risk-free plus the equity beta into bracket return on the market minus the risk-free. Okay. That is how we move with the capital. So this is what I've done over here. This is the illustration. You have what the government is giving. Then what is the market giving in excess? The market is giving that for a risk level of 1. Is your risk level 1? If it is 1, then you give what the market is giving in excess. But if your risk level is more than 1, then it means that you have to give more. How do you determine more? If 1 is equal to 4, then 1.2 will be 1.2 multiplied by 4. So you give more than what the market is giving. Then you'll be having 4.8 plus what the government is giving. You give 4.8 more than what the government is giving. So you add it to what the government is giving, and the person will now be convinced to take the 4.8 in excess because the person can go to the government and take that particular. Okay, so the risk-free. So I'm saying that if you have return on the market minus this one is called market what? Market risk premium. Market risk premium. Okay, and sometimes you have something like this. Okay. So you have the market risk premium and equity risk premium. If you find the amount that you are giving in excess, it is called the equity risk premium. Okay. So if you find the amount that you are giving in excess, that is for the equity. That is what you are giving. But what the market is giving is just the difference between the return on the market and the what government is giving. So you have the equity risk premium. So sometimes the question can give you market risk premium, or they will give you equity risk premium. Most of the times we just use the two. the risk premium, we just exchange them two. Okay. So let's come here. This is how we determine the cost of equity. So sometimes they can also give you the level of the risk, the equity beta. One is less than one, it is defensive instrument. But if it is more than one, it is aggressive instrument. The risk level is very high. So I have that one as a breakdown for everything in the notes. Okay. And sometimes they can also ask you the limitations of the equity risk premium or limitations of the CAPM. CAPM, sometimes estimating the risks is going to be a problem. Okay. It is not easy to estimate the risks, and sometimes it's also difficult to understand. All the things that we have done over here, it is difficult to understand. So you can read the limitations here, please. I'm done with the equity. Let's take some questions and finish. Okay. Okay, all the things that I've done, they are all here, so don't worry. I have them. Let's come. Let's do some simple stuff. All the things that we are doing is towards what? Determination, work. So let's look at some illustrative questions here. Someone should read for us. Let's see. Let's see what we can. Okay. So let's do AB, ABG, F. Then we do something on CAPM. CAPM is not going to complicate stuff. Okay, so we can do something on CAPM. CAPM is not complicated stuff, so we don't have to do. Let's see if we can understand. Simple. You will do more complicated stuff when we are doing weighted average cost. So A, illustrative question one. Let's just try it. I know you can do those ones straightforward. Someone should read first.
A share price is quoted at 250 Ghana cedis as div. The dividend just paid was 50 Ghana cedis and will be expected to remain constant. What is the required? What is the rate of return expected by the investors?
Okay, what are we using? Are we using dividend growth or constant dividends based on what you have there? Is the dividend growing or the dividend is going to be constant? What is being
Constant.
Constant.
So the required rate of return, the rate of return expected by investors is just a cost of equity. So how do you determine the cost of equity there? So you just come here, very straightforward. We have illustrative questions. So I have the A, cost of equity is equal to DO over PO multiplied by 100. So you pay attention to the market price. Is it SDIV or CUMDIV? Is the market price CUMDIV or SDIV?
It's a div.
SDIV. So we don't have to do anything. Okay, we don't have to do anything again. So we just come here. Dividend per share is 50, isn't it? And market price is what?
250.
250. So what are we having? Multiply 100.
20%.
20%. Okay. So 20%. We do debt. Okay. Those days I can do everything within the 3 hours. So the cost of capital. I realize that no. How can you learn all these things within 3 hours? Okay, why? So sorry. And I'm going small too, so I cannot be stressing myself like that. I've reduced it now. That's why I added those days it uses to be only 2 times in in a week, but we don't do more questions. Okay. So like those days we are even down, and the speed too, you cannot contain the speed. Although I'm still speeding, but it's better than the other one. Let's come to the B part.
Assume firm A's share price is quoted at 250 cedis cos D, and that dividend of 50 cedis has been declared not paid. Required. What rate of return is expected?
Okay. So the price given to us is what? Is Kumdiv, isn't it?
Yes.
So what do you have to do?
You have to
We'll subtract the
subtract the dividend from the price.
So we have to subtract the dividend from the price to be able to get our
the
the HD, isn't it?
250.
So let's
Two
come
hundred
here. Have the B here.
also like
The B, I'll have the KE is equal to DO divided by
50
DO multiplied by 100. So I'll come here. I'll have my 50, all right. But the down will be 250 minus 50. Do you agree?
Yes.
Okay, that will give us
25%.
25%. Let's do, since we are doing simple stuff, let's do the D. Okay. The C, they can give you dividend for, we'll talk about that. Let's come to the D. So let's do the D.
D. A company's share price is quoted at 300 cedis. Dividend just paid was 60 cedis, and growth of 10% is expected. Required. Calculate the expected rate of return on the shares.
They say the dividend just paid. It means that dividend is not part of the system, is not part of the 300. But if they say dividend yet to be paid, dividend declared but yet to be paid, unless the question is saying that it is SDIV share price, you just assume that the share price given to you is div when the question says that dividend declared but yet to be paid. It means that dividend payment will always be part of the share price. Unless the question is saying that the SDIV share price is 300. So you don't have to know, you don't have to, although the dividend has not been paid, but it's not part. But this one I said the dividend has been paid already. You are not owing dividends. So if you want to pay the people, you pay the share price with them, which is 300. So the 300 is actually what? The SDIV share price. But this is about growth. They say the growth is 10%. So we are going to be looking at the rates using growth. So I'll come here, I'll come to C. The cost of equity, which is a discount rate over here, will be TO. So the dividend, they are giving us current dividend, which is 60. We have to find the dividend a year from now. The dividend at the end of the year, which is now, the year that we are doing now. Now, the dividend is 60. But we are looking for dividend a year from now. So we have to increase it by the growth. We have to increase the dividend by 10%. It's supposed to grow by 10%. Okay. So we come here and we have PO, then all plus the G, then multiplied by the 100. So come here, my KE is equal to the 60. I'll go the 60 by 10%. That will give me 1.1, which is a proof. I'll have my 300 here, then plus the 10%, which is 0.1. Then I'll multiply the final answer by 100%. So the top, I'll be having 66 divided by 300. Add that answer to 0.1. Then you multiply everything by 100.
32%.
That is
32%.
32%. So our cost of equity is 32%. Let's take the D and take one question on the capital. We are just doing simple stuff. The focus is not on this time. We are doing all these things just to calculate weighted average cost of capital. Okay. So let's come here. We do the debt also. And we do debt, we do preference shares, we do convertible, then we do the one. We still have some stuff to do, but they are not plenty. If we know how to do the debt, then the preference shares we don't have to work. The convertible instruments we don't have to work. The work is just application of all the things that we have said. And by Thursday in the evening we finish it. Because the debt and preference shares, I know very well that we finish it Thursday done. Let's look at the F, then we pick some question on the capital. F.
F. Capco has announced that it will pay an annual dividend equal to 55% of earnings. Its earnings per share is 0.80 Ghana cedis, and it has 10 million shares in issue. The return on equity of Capco is 20%, and its current cum dividend share price is 4 cedis 60 pesos. Required. What is the cost of equity of Capco?
Okay, so let's come here. This one, let's also analyze this one. This one is it about constant dividend or dividend book? Check it. Based on the information that we have. Constant dividend or its growth?
It's growth.
It's growth. Okay. So how did you check? How did you know it's growth? Let's check. Let's analyze that. What actually informed your decision to know that it's growth? Do you all support the idea that it's growth?
Yes.
Okay, what are we seeing to arrive at that conclusion that is growth?
They are paying 55% out as dividend, so they are retaining 45.
Okay, and in addition to that, we are being given the return on equity, isn't it? We are giving return on equity. Do you agree?
Yes.
Yes.
Yes, sir.
So we can find the growth by using the retention rate by the
Yes.
return on equity. Is that correct?
Please come again, sir.
We can find the growth rate by multiplying
Yes.
the retention rate by the return on equity.
Yes.
Okay. So sometimes the question can also give you so many dividends. We come and do
Yes.
the one with the so many dividends and find how to find the growth. But let's do this one and do one on CAPM. Then we come to that one. Okay. So let's come here. This is about growth. You have to estimate the growth yourself. Why? That is not going to be an issue. Like, let's come here. I said the entity has announced it will pay an annual dividend equal to 55% of earnings. So it means that 55% of its earnings will be paid as dividends, isn't it? Is that correct?
Yes.
Okay, and 45% of
Yes.
it will be returned.
Yes.
Okay. Its earnings per share is 0.80 and it has 10 million shares in issue. The return on equity of Capco is 20% and its current cum-div share price is 4.60. What is the cost of equity of Capco? So they are giving you 10 million. We are going to be doing this per share. We find the market price per share, the dividend per share, and we also find a growth. So let's come here. This is about growth. So I'll come here and do. So let me have the F here. F, I will have the cost of equity to be the dividend per share today plus. So we are giving current dividend. We are looking for a dividend a year from now, divided by this one, then plus the G, all multiplied by the 100. Okay, let's come here. Let's determine our DO. The DO will be what? 0.55 multiplied by the current earnings per share. Do you agree? 55% of our earnings. So dividend per share will be 55% of the earnings per share. Whatever earnings that we have, 55% of it will be a dividend. So if the earnings per share is 0.8, the dividend per share will be 55% of that. So 55% of 0.8. What are we having?
0.44.
0.44. Okay, 0.44. Our PO will be 4.6 minus what?
0.44.
0.44. So we are giving give. Okay, that will give us how much? 0.12. Is that right? Or 0.16? Is it 0.16 or 0.14? Okay. It's 4.16, right?
4.16.
Sorry, I was actually confusing you, don't worry. So our growth rate will be B multiplied by R. Is that correct?
Yes,
Okay.
sir.
And our B is the retention rate. If we are paying 55% of our earnings as dividends, we are retaining 45%, so 0.45 multiplied by return on equity is 20%, 0.2. What is our answer?
0.09.
0.09. So our growth is 0.09. So we can go and deal with this particular one. So I'll come here, my cost of equity will be 0.44 into bracket 1.09 because the G is 0.09, which is 9%, then divided by 4.16 plus 0.09, or the answer multiplied by 100. Just give us the final answer. You don't have to stress like that. Or the answer is what? Yeah, someone is saying 20.5 or 21, any of them.
20.5.
Okay, 20.5%. Let's do one on WAC, CAPM. So we know that we have tackled all of them. Let's do one example on CAPM. Let's see. Then I'll come and do the if for it, or you do it together. Let's look at one thing on CAPM. We have ways of estimating the CAPM, but that one is for pure risk issues. Okay. We also have an area in this FM which is about risks, but nobody examines that one. So we also just leave it like that. We don't teach it because nobody examines what the risk. It has never been examined. So we also just leave it like that. Okay. Maybe if they come and examine it, then we go back and be teaching that area of risks. Because the ones that they're examining, we are finding it difficult to understand. What about issues of risk, which is full of formula? So we just ignore that one like that. Okay. So, but that is not any big issue. Yeah. So let's come here. Let's come here. I want to check some. So let's do something on work. What is the work? I said work. CAPEM. Okay, the question about CAPEM is the equity shares of Mines PLC. Someone should read that one.
The equity shares of Nines PLC have a beta value of 0.70. The risk-free rate of return is 8%, and the market risk premium is 5%. Corporation tax is 30%. What is the required return on the shares of Nines PLC? To 1 decimal place.
Please, this is equity. Dividend that we pay to equity shareholders does not, the entity does not enjoy tax benefit on it. So whenever you are giving tax, just ignore. You just give the tax rate over there to confuse you. Dividend is paid out of profit after tax. So there is no tax benefit on the dividend that we are paying to the equity shareholder for the company. So let's come here. You can say the government is offering how much? Government is offering how much for each security?
8%.
8%.
8%.
Yeah.
How much is the market giving in excess?
5.
5%.
But that 5% is equivalent to 1, isn't it?
Yes.
Is the risk factor, is the risk
Yes.
associated with the entity 1%? 1 is the risk factor 1. The risk is valued, the risk is measured in beta. So when I give you beta, equity beta, the beta is the risk level. So the risk level is what, 0.7, isn't it?
Yes.
So should the
Yes,
entity
please.
be given the 5% in addition to the 8% the government is giving, or they will give lower in addition? Would they give lower, or they will give higher than the 5% that the market is giving in addition to the 8%?
They will give lower in addition.
Okay. How much are they giving in essence?
5.
How much is the entity, not the market? Market is giving 5. How much would the entity be given on each security in addition to what the government is giving?
3.5.
3.5. Okay. Then how did you get a 3.5?
I multiply the beta with the market risk premium.
Okay. So how
Yes.
much would the entity be giving in total?
11.5.
11.5. So you just come here. The government one is the basis that we come here, return on the market minus the risk premium. So they have given us the difference between the return on market. So government is giving 8%. It means that the individual has if the individual do not invest in our security, he can invest in government. So he's getting 8% for free if he doesn't invest in you. So you have to give something in addition to the 8% to convince the person. But the market is saying that we are giving 5% for a risk level of 1. But your risk level is 0.7. So what will be your additional amount that you give? So you just do this one. So that will give you x is equal to 0.7 multiplied by 5. So you just multiply the amount that the market is giving in excess by your risk factor, which is 0.7 over here. So you'll be giving 0.7 by 5%. And that will give you 8% plus 3.5%. Then you'll be having 11.5%. So the cost of equity, the CAPEM is very cool and very simple. You don't have to stress. The tax is not necessary. Equity does not attract. Dividend on equity does not attract tax. The same way the question can give you that the return on the market. What is the actual return on the market? Someone should determine that for us. The return on the market is what percentage?
13.
That will be 13. The return on market will be 13 because we subtract 8 to get a risk premium. So it's actually 13 before we have taken the 8 from it to have an additional of what? Of the 5. So the question can give you the return on the market as 13. So you have to do 13 minus the 8 to have the 5, but they have actually got the difference. The R minus the F, which is the 13 minus 8 to give you the 5. So just go with the 5 straightforward. So they can give you the market, the return on the market, or they can give you the premium, any of them. They can give you the market risk premium. But if they should say that the equity risk premium is 5%, then you just take everything over there as 5%. Okay. So, but sometimes we will just interchange them, whether market premium or risk premium, we just interchange them. It is not anything. Okay. Let's come here to, let me also, okay, that is about the capping. It's not anything. They will give you all those things in the exam. For risk premium, they will give you the beta, they will give you. Okay. Although sometimes they can ask you to calculate, but they will give you. Look at the E. I'll just guide you on the view. Someone read the E for us.
Question E.
Yeah.
Sankofa Limited has a dividend cover of 4 times and recorded the following earnings after tax. The years we have 2010 to 2014. The earnings are there. Required. Calculate the average dividend growth rate for Sankofa Limited.
So what are they asking us? They're asking us to calculate dividend growth, isn't it?
Yes.
But we are giving earnings. Okay, so it means that we have to now use the earnings to find dividend. Do you agree?
Yeah.
Okay, but the dividend, we need the current dividend and then the initial dividend. We need dividend for only 210 and 214 because those are the things that we use for the growth. Okay, now you are giving something at the top. What is that? They are giving you dividend what?
Dividend cover.
How do you calculate dividend cover?
Earnings over
Matter
dividend. Earnings over dividend.
Dividend cover is what?
Earnings over dividends.
Okay, dividend cover is earnings over dividends. Okay, how many times can the earnings cover the dividend? That's what we call a dividend cover. Okay, so it is earnings over the dividends, or you might see dividend earnings per share over dividend per share. Any of them. Okay, so but if you see the question will tell dividend payout ratio. The dividend payout ratio is the reciprocal of this one. That is, what portion of the earnings are you paying as dividends? But the dividend cover is how many times can a dividend cover the what? How many times can the earnings cover the dividend? That's what we call a dividend cover. So if the earnings is actually 2,000 or 20,000, dividend is 5,000, it means that the earnings can cover the dividend what? 4 times. So therefore the dividend cover is 4. And that will be 20,000 divided by 5. 5,000, that will give us 4. So we know that our dividend cover, which is given to us, is determined as the earnings divided by dividends. Now, how do we calculate the dividend that we are looking for? Let's make the dividend the subject. So we have the dividend. So I'll use DO as a dividend multiplied by the dividend cover is equal to, I'll use E0 as the earnings. So I need to divide through by dividend cover. So if I want to know my dividend for each year, is the earnings for that year divided by what? Dividend cover. Do you agree?
Yes.
Okay. So let's come to, we need a dividend for 210 and 214. If you use the earnings to find it, you might be getting some answers similar, but it will not be similar because the dividend will be different. So you have to use dividend because the question is saying that dividend growth rate. The question can also ask you to find earnings growth rate. You just have to find your current earnings, 300,000 divided by 100,000, then exponent 1 over 1, 2, 3, 4, 5. The earnings we experience grow 4 times. Then minus 1 multiplied by 100. If you are asked to do the earnings growth, we can use that growth thing to find anything. So this is going to be train analysis. So we find the earnings for each of them. So let's count to 210. Dividend for 210 will give us what? The earnings of 100,000 divided by 4. Do you agree?
Yes.
25,000. We need only 2 dividends, the old one and then the current one. So I have 300,000 divided by 4. What am I having?
75,000.
75,000. So my dividend growth, which is the G now, I will just have 75,000, which is the current dividend, divided by the initial dividend, the old dividends, then exponent 1 over, let's come here. If you do it, how many growth will be experienced over the what? Over the period given to us? The growth will be experienced. How many growth will be experienced over the years given to us? The dividend will experience a growth of what? How many times?
4.
4. So you
3.
have, no, it's actually 4. Okay. So 210 to 215. 210 to 214 is actually 4. Okay. So I'll come here, I'll have this one. Then all minus 1. Then you multiply by 100. Very so 210 to 211 is 1. 1. 1. Let's go. If you are being born in 210, you'll be 1 year in 211, 2 years in 212, 4 years in 213, and 3 years in 213, 4 years in 214. So you grow 4 times. So the dividend have grown what? 4 times. What is the answer that you're getting? What are you getting?
31.61%. 61%.
Okay. That is it. Okay, so next week, Thursday in the morning and in the evening, we will finish everything about the cost of capital. So we look at cost of debt, and we look at cost of preference shares, cost of convertible, weighted average cost of capital, and specific cost of what? A project. Okay. They are not any issue. So we will look at that one as well. So yeah, please, I didn't see something like this over here. So let me come to the growth. Please, the growth too. You see the dividend growth, there can be issuing costs for the dividend growth too. So I didn't say it because it will follow the same thing. If there's an issuing cost without tax, we subtract the issuing cost from the price. If it is with tax, what we have done over here will be the same thing. So the denominator will be the same thing for the growth too. I've done it for this one. That's why I didn't say anything about that particular one. So if we have growth, the denominator, all the things that we have done with the issuing cost will be like that for the denominator with growth. Okay, then we look at cost of the debt and preference shares in our next meeting. Okay. All right, so please, we will continue next week, okay? But please, we're trying to solve some questions small. Okay? That is the only way that maybe you can master, although they will give you some of the, you'll be given formula sheets, and I think I have to share that with you now so that you'll be familiar with that one before I will, so I will share that one immediately with you. They'll give you formula sheets, but some of them will not be the same as what we are using, but I will still explain them to you anyway. Okay, so let's try to solve some questions. Let's be solving because we have done maybe the topics are on, but we have done some quite a number of topics. We'll be adding. For me, I'm not the one learning, so me, I'll be adding. So you have to also start now. Thank you, and enjoy the rest of your weekend. Thank you.